Here's what they never told you about wealth. The loudest person in the room is almost never the richest one. That man in the sedan, the one in the unremarkable clothes, driving a 10-year-old car through an ordinary suburb, he's worth $43 million. He made his fortune not by being seen, but by being invisible, by watching, by waiting, by doing something that almost no one in the modern world has the discipline to do. He stayed quiet. For years, we've been sold a myth that wealth belongs to the bold, to the networkers, to the ones who dominate every room, every stage, every comment section. The internet turned financial success into a performance, and millions of people bought the costume without ever building the foundation. But here's the truth. Backed by decades of research, behavioral science, and the quiet testimonies of people who actually built generational wealth, the introvert's greatest perceived weakness is in fact their most lethal financial weapon. This is the silent investor. Today we're going to show you exactly why quiet people often end up richer. Before we dive in, my name is Zahid. I hold an MBA and I'm currently a CPA candidate. I built this channel because I got tired of financial content that prioritizes performance over substance. Everything you'll hear today is grounded in real research, real data, and a genuine belief that the quietest strategy is almost always the most powerful one. Let's get into it. To understand why quiet people build wealth more effectively, you have to start inside the brain. Every time you seek external validation, every time you post a flex, buy something you don't need to impress someone you don't like, your brain releases dopamine, the same neurochemical pathway activated by gambling, by sugar, by drugs. Studies in behavioral finance have consistently shown that extroverted personality traits, particularly the need for social stimulation and external reward, correlate directly with higher levels of impulse spending, increased susceptibility to lifestyle inflation, and lower long-term savings rates. The mechanism is the dopamine loop. Spend, feel good, repeat. The brain doesn't distinguish between a wise financial decision and a reckless one. It only chases the reward. Now contrast that with the introvert's neurological baseline. Susan Cain, in her landmark research on introversion, identified a concept that financial psychologists have since adopted with remarkable implications. She found that introverts operate at a fundamentally higher baseline arousal level. The external world doesn't need to give them a jolt to feel engaged. They are, neurologically, already closer to their optimal stimulation threshold. The result? They don't need the Lamborghini to feel alive. They don't need the designer watch to feel worthy. The dopamine hit that sends an extrovert reaching for his credit card simply doesn't register the same way in a quieter brain. This isn't a personality quirk. This is a structural financial advantage that compounds over decades. While the loud investor chases his next status purchase, the quiet one redirects that capital into assets, into index funds, into real estate, into businesses built in silence. The lifestyle creep that destroys most people's wealth potential never gets a foothold in the quiet mind. Not because of willpower, but because the neurochemical pull isn't as strong. That difference over a 20-year investing horizon is the difference between financial independence and financial servitude. But here's where it gets genuinely unsettling, because the quiet person's advantage isn't just about what they don't spend. It's about what they hear in a room full of people talking that no one else is listening to. And the data on this next point will fundamentally change how you think about who is actually winning. In 1996, Thomas J. Stanley and William D. Danko published what may be the most important wealth study ever conducted, The Millionaire Next Door. Their methodology was simple. They went looking for millionaires in wealthy zip codes, penthouses, gated communities, luxury car dealerships. They found very few. Then they went to the ordinary neighborhoods, to the accountants, engineers, and small business owners in modest houses, and they found them everywhere. Stanley's data was staggering. The vast majority of American millionaires did not look the part. They drove used cars, they wore off-brand clothing, they lived in homes worth a fraction of what they could afford. They were, in Stanley's phrase, prodigious accumulators of wealth, and overwhelmingly they shared one behavioral trait. They listened far more than they talked. This is the noise filtration advantage. When you are the loudest voice in the room, you are, by definition, receiving zero new information. You already know everything you're saying, but the quiet person, the one who asks one precise question and then leans back, absorbs everything. The hesitations, the overclaims, the fear masked as confidence, the opportunity masked as risk. In financial markets, this translates to the ability to spot asymmetric information, the gap between what a market believes and what is actually true. Studies on investor behavior consistently show that emotional reactivity, panic selling in downturns, FOMO buying at peaks, is significantly higher in socially stimulated personalities. The need to be part of the narrative drives catastrophic decisions at exactly the wrong moment. The quiet investor doesn't need to be part of the narrative. They are watching it. And when everyone else is shouting, when the market is collapsing and panic is contagious, the quiet investor is running numbers. blocking out the noise and finding the entry point that everyone else was too distracted to see. Everything so far deals with the quiet person's external behavior, but the most powerful advantage may be happening entirely inside their mind, in a cognitive state that modern neuroscience is only beginning to fully understand. It may explain why the greatest investors in history all share one obscure daily habit. Research from Harvard examining cognitive performance found that individuals who spent deliberate, structured time in solitude, without social input or ambient distraction, demonstrated measurably superior performance on complex, multivariable decision tasks, the kind of decisions that determine the outcome of a financial life. Susan Cain's work adds a crucial layer with her concept of restorative niches, the protected spaces introverts instinctively seek to decompress and think. What her research reveals, and what Cal Newport later expanded in deep work, is that these periods of cognitive isolation aren't a retreat from productivity. They are the engine of it. The quiet person, left alone with a problem, enters a state of focused analytical processing that is neurologically incompatible with the socially stimulated brain. They are running a different operating system. In financial strategy, this is decisive. Market panics are social events. FOMO is a social phenomenon. The herd mentality that drives retail investors to buy at peaks and sell at bottoms is fundamentally social contagion, the same mechanism that drives crowds everywhere. The quiet investor is structurally less susceptible. Their default mode is independent analysis, not consensus seeking. This is how generational wealth is built, not on the trading floor, not in the comment section of a finance subreddit, but in silence, in the deliberate, protected space that quiet people create instinctively and that loud people almost never enter willingly. But there is one final dimension that most financial channels will never discuss, because what comes next isn't about building wealth. It's about protecting it. It's about the hidden tax that visibility imposes on your net worth, one no accountant can offset, and that the loud investor pays every single year without ever seeing a bill. There is a concept in behavioral economics called social visibility risk, the measurable financial cost of publicly displaying wealth. It operates across multiple dimensions simultaneously. The first is relational predation. When people know what you're worth, they come for it. High visibility wealth attracts lawsuits, business disputes, and predatory relationships at dramatically higher rates than concealed wealth. Attorneys who specialize in high net worth litigation will tell you privately, the client who drove the Ferrari to the deposition made their job significantly harder. The quiet investor presents no target. The second is the social tax, the informal but very real financial drain of being visibly affluent, the expectation to pick up the check, the pressure to match the spending of those around you, the cost of maintaining an image that was never an investment. Stanley's data made this explicit. People who looked wealthy were, on average, significantly less wealthy than those who didn't. The correlation between visible luxury and actual liquid net worth was inverse. You perform wealth, or you build it. Rarely both. The third dimension is informational advantage. When your competitors, your counterparties, and your market don't know your position, your holdings, your health, your next move, they cannot play against you. Every negotiation you enter carries information asymmetry in your favor. Every deal is priced without the other side understanding your leverage. Privacy is not a lifestyle preference. It is a compounding financial asset, one that pays dividends in every transaction, every negotiation, every strategic decision, silently and indefinitely. Here is what we know. Quiet people avoid the dopamine traps that erode wealth before it's built. They filter the noise that misleads emotional investors. They access cognitive states that produce better decisions. And they use invisibility as a shield that protects everything they've built. This is not a consolation prize for being introverted. This is a blueprint. The world will always reward loudness with attention. But attention is not wealth. Attention is noise. And noise, as every quiet person already knows, is the enemy of everything that truly matters. The real power move has never been the loudest one. It has always been the one no one saw coming. If this resonates with how you think about money, strategy, and building something real in a world addicted to performance, subscribe to The Silent Investor. Hit the bell. Share this with someone who's building quietly. This channel exists for the ones who don't need to be the loudest in the room, just the most prepared. We're just getting started, and I don't want you to miss what's coming next. The quiet ones are gathering, and they are winning.